Did you know current market trends closely mirror those seen just before past major recessions? Renowned investor Jeremy Grantham has raised the alarm about the impending economic downturn. He points to overvalued stock markets and unsustainable growth fueled by loose monetary prices as key indicators of potential trouble. He predicts that a severe recession could be just around the corner, likely to significantly affect economies worldwide. He urges investors to closely examine their portfolios for vulnerabilities that might lead to substantial financial losses during such a downturn. So, are your investments secure against the threat of a looming recession? Stick with us to discover effective strategies for protecting your financial future in these uncertain times. The US market. First, let's unpack a doozy from Jeremy Grantham, the mastermind behind GMO and a known sage when it comes to predicting market bubbles. In his eye-opening report, The Great Paradox of the US Market, Grantham explains where he thinks the market is heading. And trust me, it's worth paying attention to. Here's the scoop. On March 1st, the Shiller P/E ratio of the S&P 500 hit a staggering 34. This little number is more significant than you might think. It ranks in the top 1% of all-time highs for this metric, which adjusts stock prices against a 10-year average of earnings. That's not just a peak, it's Mount Everest. But while the stock market is partying like there's no tomorrow with near-record corporate profits, Grantham throws in a buzzkill. This is a classic case of double counting and double jeopardy. What he's saying is we're celebrating these high profits twice, boosting the market to dangerously inflated levels. And why does this matter? Because according to Grantham, our stock prices are painting a picture of perfection in a world that's anything but. We're looking at a cocktail of chaos with ongoing international conflicts, economic strains across Europe and Asia, housing prices through the roof, a squeeze on commercial real estate, environmental damage, depleting resources, and aging populations. Grantham isn't just worried. He sounds a five-alarm fire bell on this extreme and illogical market enthusiasm. But here's a chilling fact. There's never been a sustained stock market rally that started from a Shiller P/E of 34 amidst full employment. Historical trends show that similar setups have led to the most epic crashes, like the Great Depression and the dot-com bubble burst. So, what's the take-home message? Grantham believes the broad US stock market outlook is as grim as ever. While the current rally might feel exhilarating, the fundamentals suggest we could be on the brink of a significant downturn. Booms become bubbles. Now, in a recent discussion, Grantham reflects on the roller coaster the global economy has been on. Remember the massive economic stimulus during the pandemic in 2021? That pumped up what Grantham calls a multi-asset bubble, which started to deflate in 2022. Just as things seem to be calming down, enter stage left, ChatGPT. That's right, the emergence of advanced AI technologies threw a spanner in the works, puffing up what Grantham believes is a brand new bubble. Now, Grantham isn't just throwing shade at AI. He acknowledges its potential to transform our world, possibly even more than the internet did. But he warns, brace yourself for a familiar pattern we've seen with tech revolutions. A surge of excitement leads to a stock market frenzy, which is then followed by a phasing of disappointment and a burst bubble. Take Amazon as a classic case study. Its stock skyrocketed 21-fold from early 1998 to its peak in 1999, only to plummet by 92% by 2002. When the dot-com bubble burst, however, it's worth noting that Amazon eventually climbed its way to dominate global retail. Grantham sees a similar path unfolding with the current AI craze, predicting this bubble will also pop, at least temporarily deflating and likely ending the original pandemic-induced bubble. Moreover, Grantham highlights another critical factor influencing the economy: the Federal Reserve's interest rate hikes. Combined with what he calls ridiculous speculation from recent years, these adjustments are likely steering us towards a recession. Despite the grim outlook, Grantham identifies opportunities in the chaos. He points to high-quality and deep-value stocks, especially those linked to resources or aimed at tackling the climate crisis, as the most promising investments in an overpriced U.S. stock market. He also sees greater value in foreign markets compared to the U.S., urging investors to look globally. So, what are some of the things you should do? Focus on quality. If you're confident about the U.S. market and plan to keep your investments domestic, Grantham stresses one key word: quality. But what does quality really mean in the stock market? It's all about finding companies whose true value isn't fully reflected in their current stock prices. Consider AAA bonds, known for their top-tier creditworthiness and minimal risk. Grantham points out that these bonds perform exceptionally well in bear markets, albeit less so in bull markets. Why? Simply put, they're not as flashy or exciting as the Teslas and meme stocks of the world. Everyone wants to own the latest and greatest in a bull market, chasing high returns with high-risk investments. But Grantham reminds us, you don't want to own Coca-Cola. It's just too boring. Yet, Coca-Cola consistently performs well in the grand scheme due to its stability and enduring market presence. A true quality investment, according to Grantham, features low debt, high and stable returns, less volatility, and a lower risk of bankruptcy. These investments might not make daily headlines, but they offer sustainable growth and security over time, outperforming their more volatile counterparts. Now, Jeremy Grantham's assets management firm, GMO, launched its first exchange-traded fund, ETF, named the GMO US Quality ETF. This ETF is designed to tap into the trend of investing in high-quality stocks, which are companies known for high and stable profitability and strong balance sheets. Holdings in GMO's quality stock-focused mutual funds include major companies like Microsoft, Johnson & Johnson, and Apple. This ETF seeks to expose investors to such quality stocks, aligning with Grantham's investment philosophy that favors sustainable and stable investment opportunities. And it's not just Grantham singing this tune. Warren Buffett, one of the most successful investors of all time, also champions this approach. Buffett's strategy focuses on high-quality businesses with low capital needs, like Apple, which comprises over 45% of Berkshire Hathaway's portfolio, valued at over $165 billion. This emphasizes not just the allure of high-quality investments, but also their profitability. Investing in quality might seem like a slow and steady approach in a world where quick gains get the most attention. However, the truth is that focusing on quality is a proven strategy for long-term success in the stock market. Whether you're weathering a bear market or planning for future stability, quality investments are a cornerstone of a sound financial portfolio. But it's not only quality that we should focus on. Grantham recently shared his insights on several key investment opportunities that could be pivotal for investors looking for long-term growth and diversification. Have you ever considered why investing in natural resources could be smart? Grantham says it's not just because they are finite and getting scarcer by the day, though that's a big part of it. These stocks are a rarity in the investment world because they tend to move in the opposite direction of the broader stock market. Imagine that when most of your portfolio zigs, these stocks zag. Right now, they're also relatively cheap, having taken a hit recently, which Grantham sees as a perfect opportunity to buy in at a low price for potentially high rewards. But it doesn't stop there. With increasing awareness of climate change and greater willingness among governments to address it, Grantham sees climate-focused equities as a promising area for investment. He argues that these investments will likely experience above-average revenue growth for many decades, thanks to ongoing efforts to combat climate change. However, he cautions that the growth in this sector might not be smooth. Notably, climate investments are susceptible to discount rates, which have been impacted by rising rates in the past few years. According to Grantham, the market has overreacted to these rate increases, resulting in climate-focused equities, particularly solar stocks, being significantly undervalued, over 50% cheaper than the broader market. Now, do you ever love finding a great deal? That's what deep value stocks are all about. These are the market's underappreciated gems, stocks that are trading for less than their inherent worth. Grantham points out that the gap between these stock prices and their real value is about as wide as it gets, signaling a potentially lucrative buying opportunity. For investors willing to dig deep, these stocks could offer a significant payoff as the market begins recognizing their actual value. Now, if you're feeling unsure about the US market, maybe it's time to think globally. Going global. You see, the primary benefits of investing internationally include diversification, access to a broader range of opportunities, and tapping into the growth potential of various economies worldwide. At the same time, the prospect of international investing might seem daunting due to potential complexities like currency fluctuations, tax implications, and varying business practices. Modern financial services have made it more accessible than ever. For those looking to explore foreign markets, there are several practical options. One is opening a global account with brokers such as Fidelity, E-Trade, or Interactive Brokers, which allows direct purchases of international stocks. However, this method might not suit the average investor due to the additional costs and complex support issues involved. A more user-friendly alternative is investing in exchange-traded funds, ETFs, that focus on international markets. ETFs, such as the Vanguard FTSE Developed Markets ETF, provide access to companies in developed markets like Western Europe, Japan, and Australia, covering approximately 3,700 firms. For those interested in emerging markets, the iShares MSCI Emerging Market Small Cap ETF offers exposure to smaller companies in regions like Taiwan, India, and Brazil. Now, speaking of Japan, as global investors seek diversification and growth opportunities, Japan has emerged as a compelling market. Particularly noted for its technological prowess and strategic positioning in Asia. Despite the global attention on American mega-cap technology stocks, Japan's Nikkei 225 index has demonstrated remarkable performance, surpassing its previous peak from 1989 to early 2024. This resurgence is driven by a combination of ultra-low interest rates, a weak yen enhancing the competitiveness of its export sector, and significant corporate governance reforms. Moreover, Japan's status as a hub in the heart of Asia positions it as a favorable alternative to other regional markets, especially amidst uncertainties in China. This unique combination of economic and strategic factors makes Japan an attractive option for investors looking to expand their global footprint and capitalize on Japan's technological edge in sectors like electronics and machinery manufacturing. Another easy method is through American Depository Receipts, ADRs, which represent shares in foreign companies but are traded on U.S. exchanges. ADRs simplify the investment process by mitigating many direct challenges associated with international stock purchases, such as dealing with foreign currency or understanding overseas tax regulations. It's crucial, however, to recognize the risks associated with foreign investing, including political instability and currency risks, which can impact returns. For newer investors, a cautious approach might involve using an investment app to start with low stakes, gradually increasing exposure as they gain more confidence and experience in international markets. This strategy allows investors to navigate and learn about the complexities of global investing in a more controlled and manageable way. As we've seen, the signs of an impending recession, as pointed out by Jeremy Grantham, are clear and concerning. Protecting your investments during these turbulent times requires foresight and a well-thought-out strategy. So, have you evaluated how recession-proof your portfolio is? Share your thoughts and strategies in the comments below. Also, leave a like, subscribe, and don't forget to turn on the notification bell.